Welcome to the Advisory Group's Economic and Market Update to start the third quarter of 2022. Thank you for attending our webinar. Let's first start with some introductions. My name is Manny Chinche and I am a Senior Advisor here with the Advisory Group. Also joining me is Brent Beverly, the President of the Advisory Group. Both of us are Certified Financial Planner Practitioners, CFPs. At our firm, we partner with our clients and believe that an educated client is our best client. So while we will always try our best to help you, when it comes to your finances, we believe that knowledge is power. And one of our missions is to share with you any knowledge that can better help you make an informed decision. So let's address the elephant in the room up front, or should we say the bear in the room? Investors have seen multiple record highs over the last few years in the stock market, and we knew that at some point a market correction was inevitable. Now, the Dow Jones Industrial Average just registered its worst half of a year since 1962. That's 60 years. And the S&P 500 had its worst first half of the year drop since 1970. This type of market movement is unpleasant to watch and can make even the most patient of investors uncomfortable. The brunt of the downturn was this quarter when the Dow ended down 11.3% and the S&P 500 closed the quarter down 16.4%. Now, this is a far cry from the bull market where investors were treated to equity markets that more than doubled between the March 2020 lows until January of this year. Now, this is a good time to remember one of Warren Buffett's famous quotes. The stock market is a device for transferring money from the impatient to the patient. Now, it's key for investors to remember that equities are long-term investments, and any panic-driven impromptu moves that deviate from your plan could very well be costly. So let's review this quarter's bumpy ride. Now, the second quarter continued this year's theme of heavy volatility, and the S&P 500 is officially in a bear market. The Federal Reserve raised interest rates by 0.75%. This is the biggest rate hike since 1994, and their narrative said we should expect additional rate hikes this year. Inflation is still an issue for consumers, and we have yet to see if the Fed's defense of raising rates will work to cause a retreat in that inflation rate. The world continues to see unrest, particularly with the war in the Ukraine. Also, let's not forget about COVID. China, the second largest economy in the world and a manufacturer of mass products, still holds a zero COVID policy and could have more lockdowns that affect the supply chain at any moment. This is a good time for investors to keep in mind that even though we have experienced a downturn, the S&P 500 is still well above the 2020 low caused by the pandemic. Once again, equities are mostly for long-term investments. So as we mentioned earlier, the S&P 500 is now officially in bear market territory. Now, bear markets are defined when the market drops 20% below a previous high, and they are a normal part of the investment experience. The good news is that historically they have lasted for significantly less time than the bull markets. Bears last an average of 9.6 months, while bulls last an average of 2.7 years. Now, the long-term average frequency between bear markets is 3.6 years. This means an investor could see about 14 bear markets in a 50-year investment window. Since 1930, the market has been bearish for a total time period equal to 20.6 years. What does this mean? This means that stocks have been on the rise for the other 71.4 years. Now, many reports are saying that recessions usually follow bear markets. However, the facts are that of the 26 recorded bear markets, only a little more than half came with a recession. Now, recession can be a very scary word, so let's quickly address recessions. Now, the actual definition of a recession is defined by the National Bureau of Economic Research's Business Cycle Dating Committee. They explain that A recession involves significant decline in economic activity that is spread across the economy and lasts more than a few months. Now, while we now have 2 consecutive quarters of declining gross domestic product, or GDP, the U.S. Department of Labor statistics show unemployment at 3.6% in May, the lowest since the pandemic, and consumer spending is still strong despite inflation. Remember, equity markets are still well above pandemic-driven declines. So while possible, some experts believe we will not see a recession in the near future. However, there is cause for concern, and we're keeping a very close eye on the economic environment and indicators of such a recession. Please also understand that even if we do go into a recession, this does not mean that investors will get wiped out. So do keep in mind and remember, a recession does not equal the Great Depression. Although there is no established formal inflation target, the Federal Reserve generally believes that an approximately 2% rate of inflation is acceptable. Now, the Consumer Price Index, CPI, rose to a whopping 9.1% in June, according to the Labor Department, marking the highest year-over-year inflation since December of 1981. Now, many of the increases that affect us personally seem much higher than the official average rate. Where are we seeing inflation hit the most? Gas prices, grocery stores, automobiles, housing prices, also very heavy increases in the last year. Now note that there are many other items that did not increase this much, which is what keeps the average down to that 9.1%. In fact, some items decreased, such as the real average hourly earnings shown in our chart. Standing by its commitment to fight inflation, on June 15th, the Federal Reserve again raised interest rates, this time by 75 basis points, 0.75%, the biggest single rate hike since 1994. Now add that to the 0.75% increase already implemented this year, and this brings the federal funds rate to a target range of 1.5% to 1.75%. Wall Street responded with sell-offs, taking the S&P 500 officially into bear market territory. And in late June, the Dow Jones Industrial Average dropped below 30,000 for the first time since January of 2021. Short-term safety comes with a cost. Have you seen what interest rates banks are currently offering to savers? According to Barron's, the average bank money market rates on July 4th were 0.09%, and the average 12-month CD rate was 0.39%. Now, while this is significantly above the ultra-low levels of last year, it still is nowhere near what it takes to stay ahead of inflation. For many investors, today's ultra-low rates may not help them reach their goals. Therefore, equities should still be considered to be a part of a diversified portfolio. Now, let's go over additional ways to look at these markets. To do that, let me bring up Brent Beverly. Brent?
Well, thank you, Manny. Well, as Manny demonstrated in his portion of our presentation of our market update, you know that the markets are down. They're down substantially. Now, let's perhaps change your perspective a little bit here, though. Down markets can be used to add value to your long-term investments. What? Brent, are you telling me that down markets can be a good thing? Well, my answer is yes, and let me show you why. First of all, remember that while we know that crashes and market corrections are uncomfortable, remember they're common. They happen quite a bit. We know down markets occur pretty regularly. As Manny noted earlier, bear markets are defined as a downturn exceeding minus 20%, and they tend to occur every 3.6 years or so. The real question every time we see a bear market is, what can we do? What should we do? There are strategies that may help you in the long run that you can take advantage of when markets go down. Now, we're not going to spend a lot of time on this portion of it today, as they can get very technical and don't work for everyone. But consider these. Look to take advantage of tax loss harvesting to offset gains elsewhere or gains in the future. Roth conversions and down years can mean additional growth that occurs within a tax-free Roth IRA rather than building up taxable income in a traditional IRA. Now, you may want to gift to family members so the appreciation applies to their future, not to yours. Now, this is especially appealing for high net worth individuals or couples who are looking to maximize their lifetime gifting. So remember, the current high estate exemption levels are scheduled to drop dramatically in 2025, just a couple of years from now. So this may be a great time to make that estate transfer to freeze the values in your estate and take advantage of these high estate tax exemption levels that we have. Now, often we see someone with highly appreciated stock who wants to gift that stock to charity. Well, in times when stock prices are low, it may make more sense to use the IRA assets, especially for taxpayers over the age of 70 and a half. If you're over that age, you can make qualified charitable distributions, QCDs, of up to $100,000 per year without paying tax on the IRA income. Now, a much more complex idea is that if you have company stock in your employer retirement plan, you may be looking to do what's called net unrealized appreciation, or NUA, with that stock when you retire. Now, using NUA can reduce your taxes dramatically when you leave the company. If the price of that company stock is low enough now, it may allow you to reset the basis on that stock, lowering your taxable income in the future even more. So we refer to this strategy as net realized depreciation. So another strategy that you can use. Now, there are a lot of reasons to take actions when market values are low. Now, none of these strategies is for the uninformed. All right? Don't try these on your own. Before you use this, be sure you work with your advisory team, your financial planner, your CPA, and your attorney to make sure you get it right and get it right the first time. Now, this is a good time to review the fundamentals of investing. These are very basic concepts, but guys, this is how the world really works. That's why we use it year after year after year. First of all, history has provided great evidence that markets go up and markets go down. And since no one can time markets, we need to have a real plan for long-term investing. Now, not all investments are alike. Some are riskier than others. Now, we'll talk more about volatility here in a minute, but some investments are simply more volatile. That is, they go up and down in value more than in the short term than other investments do. Some investments may be more stable in the short term, but face a loss of spending power in the long term. You've heard this before. There's no single investment that fits all your needs. You need to have diversified investments. By diversifying your investments in a mix that fits your needs and your goals, you can help control your investment risks. Moreover, there's no single investment that is suitable for every investor. That's why we get to know your circumstances, your goals, your feelings on risk, and then help recommend investments that are suitable for you and your situation. Big point here. What is the biggest problem most investors face? If you've attended our webinars in previous years on investments, if you've attended our sessions when any new client comes in, you know that the investor's greatest problem is emotion. And a lot of people are facing emotion right now because investors get emotional about investment holdings. We all do. All right, what we have here is the emotional cycle as it relates to the investing cycle. So we see many investors experience disappointing returns because they have an emotional, undisciplined approach to investing. You can see the quote here at the bottom of your screen by investment writer Robert Arnault. We've dealt with him for years. In investing, what is comfortable is rarely profitable. Another quote that I heard recently was, an investment is a lot like a bar of soap. The more you touch it, the smaller it gets. So let's look closely at this cycle of investments and emotion, illustrated here. As many people begin to invest, they're fearful. They have a basic emotion of fear. Perhaps they've seen previous recessions or down markets, and the thought of possibly losing money on your investments, it just drives that fear. However, we regularly see investment values start to increase, as you learned earlier. And guess what? You start to be hopeful and optimistic. Hey, this investment looks like it's rising. It's going to rise even higher. Now, lots of buying typically takes place at this level, and when investors are really enthusiastic about the market, it seems like markets will go up forever, and it's time to jump on the bandwagon. And sure enough, it does. It goes up more. And as the market continues to advance, greed inevitably takes over. You and other investors begin to feel greedy and think there's no stopping this market. It's going to go up forever. It's never going to turn around. And so you buy, and you buy big. Now, what happens right after you buy big? I don't know about you, but every time I do, guess what? Other people tend to disagree. The market rise can continue. They start to sell, and the market goes down. Now, you may be hoping that the downturn is limited, that it's just a small downturn, and that you're just seeing a short drop. But guess what? No, it just continues to fall. Pretty soon, you're back to the emotion of hope. I hope it doesn't go down. I hope it doesn't go down. But, of course, it does. And, in fact, it drops so much that your investment may go below where you started even. You're so fearful at this point that you may consider selling and getting out altogether. Booking an overall loss, not giving your investment a chance to recover. Well, and at some point, that cycle just repeats itself. Fear, hope, greed, back to hope, back to fear. Guys, we've been doing this all a long time. We've seen this before. So what did you do if you followed this cycle, the emotional cycle? We already noted that the way to invest successfully is to buy low and sell high. But investors who let their emotions steer them end up doing the complete opposite. They buy high and sell low and wonder why they lost money. This is a common experience for many investors and demonstrates how an emotional response to volatility and risk can lead to disappointing performance over time. As your advisors, we're here to take on that emotion on your behalf and provide that objectivity that helps you stick with your original game plan. And we expect the ups and downs, and we don't respond with knee-jerk emotional reactions during down times. Since volatile markets occur often, how can we actually make those down markets work to an investor's benefit? Now, one way we do this is we use an investment strategy called dollar cost averaging. And if you've worked with us for a while, you've heard us talk about dollar cost averaging before. So dollar cost averaging simply says that you invest a similar amount on a regular basis over a long period of market fluctuations. Now let's be clear here. Dollar cost averaging does not guarantee that an investor will make money. Periodic investment plans do not assure a profit or protect against a loss. In declining markets, they won't. Such plans involve a continuous investment in securities, regardless of fluctuating price values. Now, we know that investors should consider their financial ability to continue those purchases, even during periods of low price levels. That's what makes the strategy work. Now, if you get the other result, which is the market just goes straight up from where you start investing, well, stretching out the investment timelines does not add any value, and in fact may detract some from your investment value. What dollar cost averaging does is it helps make sure that you're not putting all of your money in at the top. At the same time, it also guarantees you don't get all of your invested dollars invested at the very bottom. You get some of each. What it does is it helps load the odds in your favor. It helps load those long-term odds in your favor. So let's review how that works. Here you see the same market chart we used just a minute ago. Markets go up, markets go down. Now let's say in our example here that you're investing $1,000 each month. And the first time you invest, your mutual fund or whatever vehicle you're using to invest is at $20 a share. So you invest your $1,000 at $20 a share. So you bought 50 shares. This is not complicated math. We'll do the math for you. All right. So what happens the day after you buy? All right, if you're like me, it doesn't take any time at all before the market drops. And for our example here, let's say it drops all the way down to $10 a share. Now, the next time you invest your $1,000, you're buying in at $10 a share. So $1,000 at $10 a share, you bought 100 shares. Now, most people would look at these results at this point and say, well, I bought shares at $20 per share and I bought shares at $10 a share. My average cost per share is halfway between $20 and $10 or $15 a share. But wait, let's do the math. In this example, we spent $2,000 and we bought 150 shares. Now, if you do the math on that, your average cost per share is only $13.33, almost as if we put in all of our money down near the bottom. The strategy forced us to buy more shares at the lower price, i.e., loading the odds in your favor. How does this affect you in the current down market? Well, having up-down markets allows you to invest at lower prices when the market is down. In our example, when we bought the additional shares for $10, if we just looked at our portfolio at that point, our investment's down hugely. If we were emotional about our investment, we would likely not want to buy any future investments at that point. In truth, though, having the down market actually makes it work better for you in the long run, doesn't it? Now, one of the adjustments that we typically make in these markets when we see them coming is we like to try and do more investing in income-producing investments, such as growth and income stocks and mutual funds. Now, this gives us additional cash flow coming out as the market fluctuates. Reinvesting those dividends and interest into the markets, particularly when they're low, can boost your long-term results. One of the strategies that we use for investing here. So where are we in today's market? Are we high? Are we low? Well, I think we can all agree we're not at the peak of the markets, right? To kind of come off of that. But are we here with a lot more down to go? Are we here with some down to go? Are we at the bottom? Or, hey, are we already started back up? We've had some decent days here. So no one knows. But let's just say that we're in the market at this point, somewhere in the middle. And you decide to sell out and sit on the sidelines. While the market continues down, you think you're really smart and you bailed out, you missed all this downturn. But the question is, when do you get back in? Do you really think that you can time the bottom of the market to get back in? Well, just as no one knows when the top of the market is, no one can time the bottoms of the market either. By the time you realize that the markets are going back up and that you'd better get back in, you're likely to have missed the point where you got out. In other words, you're likely to have sold low and bought back in at a higher level. You would have been better off simply holding on to your investments through the cycle. In order for market timing to work, you have to be right twice, when you get out and when you go back in. Now, we use that smooth chart to make these trends easier to see in our examples. We've drawn these up, down markets and smooth cycles, but in the real world, they're anything but smooth. Up and down moves can change on almost a daily, in fact, they do change on a daily basis. So let's take a look at this year as an example of what we're discussing. This is a chart of the S&P 500 since the beginning of the year. If you were going to try to time this market, where would you bail out and where would you look to go back in? Up, down, up, down, up, down. We say it again. No one can time markets. Don't try. It's a losing proposition. It's important to keep things in perspective. Now, we feel that volatility isn't likely to go away in the coming months, so investors need to be prepared. Remember, if you have a well-diversified long-term financial plan, abandoning ship now is probably not in your best interest. As you can see from this chart, even with the current downturn, and even with all the ups and downs along the way, long-term investors who have stayed in their market over 10, 20, or 40 years were rewarded with considerable gains. That's the secret of long-term investing. So let's review our outlook for the coming months. In the coming months, we expect to see more interest rate hikes from the Feds. No surprise there. The cost of loans are higher, most notably mortgage rates. If you're planning on any large interest-bearing purchases, you may want to consider having liquidity for those purchases. See if you can buy them some other way. As we mentioned earlier, there are still many variables in the geopolitical unrest, continuing health concerns that affect the speed and direction of the economy. We're keeping a watchful eye on these events or changes that may affect your personal situation. So here are some things that we feel could be beneficial to do in light of these rising interest rates. Review all your income producing investments. Check your mortgage rates. If they are high, look for opportunities to refinance to get a better rate if you haven't already done so. If you're higher than the existing rates, consider refinancing. Maintain liquidity for your near-term needs so you don't have to borrow money at higher rates unless you need to. Reevaluate and confirm your cash flow needs. And sometime during this year, conduct a full review of your financial plan with your financial advisor. During this review, we can look at your risk management, how well diversified your plan is, and revisit your time horizons to make sure that all of the items that you're dealing with are still compatible with your goals. We recommend that you not panic and go into fear in this market. In our opinion, the most important concept of investing continues to be stay calm and keep a long-term perspective. The advisory group is here to help you stay calm and keep that long-term perspective. We've talked about this before. We will talk about this again. This is the key. The last few years have reminded us that anything can happen. This is why we always abide by our mantra of proceed with caution. These are challenging times for investors, and we want you to be comfortable knowing that we are staying apprised of the situations that may affect you. Having a proactive approach in your financial goals and a solid investment strategy is part of the holistic offerings that we provide to our clients. It's important that you stay on top of some of the details here. I'm not going to spend a lot of time with this today. Please pause your recording, take a look at some of these disclosures, and make sure that you understand them. If you have any questions, reach out to us. If there's anything we can do to help you, again, reach out to us. This is our contact information, and if you need help, that's what we're here for. All right, so we appreciate you taking the time today. Have a wonderful time today and a wonderful and safe and healthy 2022. Thank you very much.